If you've gone looking into Division 7A online, the message you'll get is pretty consistent. It's a trap. It's a headache. It's the thing that catches business owners out and lands them with a big tax bill they didn't see coming. And for one version of it, that's fair enough. But I put my clients into a Division 7A loan on purpose, but not the one you're used to hearing about. And it's one of the more useful things I set up for the people I look after in tax. I've been doing these for a long time, and I've watched them do exactly what they're meant to do when a client's life finally throws up the moment to use these Division 7A loans. So what I want to do in this video is show you how the strategy actually works. First, quickly, what are we even talking about? When you run money through a trust and you distribute some of it down to a company, what we call a bucket company, that company pays tax at 30%. That's usually a good thing because 30% is lower than the top personal rate. But the tax office has a rule about it. Once you've distributed that money to the company on paper, you can't just leave it floating there forever. There's a reckoning day, folks. At some point, you've either got to physically move the cash across to the bucket company or put it on a proper loan with interest and pay it back over time. That loan is Division 7A. And when that day comes, what matters is being able to invest that money tax effectively. And that's exactly where a Division 7A loan becomes useful. That's all it is. The way money owed to your own company gets handled. And in the right hands, it's genuinely useful. Now, let me agree with a fair bit of criticism out there about it, because a lot of it's true. If you take money out of a company and there's no proper loan agreement behind it, the tax office treats that as an unfranked dividend, which means you get taxed on it on top of the tax the company's already paid. So yes, done carelessly, Division 7A will bite you, and the people warning you about that are not wrong. The other thing you'll hear is that the standard 7-year Division 7A loan is just kicking the can down the road. You set up a 7-year unsecured loan and pay it back with interest, and at the end of it, you haven't already saved anything. You've just delayed the tax bill. And honestly, if you're using the 7-year version as a blanket way to delay tax, I'd agree with that too. It's not something I reach for by default. I do use it now and then. If a client has a big financial year, a lot of profit lands that year, and we both know the next couple of years are going to be a bit quieter, then a 7-year Division 7A loan can smooth the tax out. It's a timing tool for a very specific situation. But that 7-year loan isn't the one I build strategies around, and it's not the one this video is really about. What I want to talk about is the 25-year Division 7A loan, which is secured by a mortgage over real property. The way the 25-year version works is that you have to put a property up as security for the loan. So what that means is you need to register a mortgage over a piece of real estate that you own, often the family home, and that mortgage is the guarantee behind the loan. It's the same idea as when a bank lends money for you to buy a house. The house is security, and if the loan isn't paid, the lender has a legal claim over it. Here, it's the same mechanism, just that the lender is your own company instead of a bank. When you first set it up, the property has to be worth at least 110% of the loan. So if you were borrowing, say, $500,000, the property behind needs to be worth at least $550,000 after the loan is taken off. On top of that, you need a written loan agreement in place before the company lodges its tax return. And the interest each year has to be at least the benchmark rate the tax office publishes for Division 7A, and that sits a couple of points above a normal mortgage interest rate. Now, here's how we actually set it up for a client. A lot of people, by the time they're in their late 30s or 40s, and they've been in business a while, they've either paid off their home or they've paid it down a long way. So what we do is go to a conveyancer and put a mortgage over the home. And the lender on that mortgage is your own bucket company. So say your bucket company is called Smith Holdings. You put a mortgage over your home and it lists Smith Holdings as the mortgagee, which just means your company is the one the loan is owed to. It costs about $800 to have the conveyancer draw this up for you. And now you've got a 25-year principal and interest loan, and it's a loan to yourself, essentially because you own the company, which raises the obvious question. If you're paying that loan back for 25 years, where's the money coming from? And doesn't it hurt to be making repayments that whole time? And that's where the strategy actually lives. The repayment is where it gets clever, because you pay it using money the company has already been taxed on. So you're not pulling new cash out of anywhere to service it. So say your trust distributes $500,000 down to the bucket company. The company pays its 30% tax on that, which is $150,000, and that leaves $350,000 in cash with a franking credit sitting against it. That $350,000 is then loaned back to your family trust on the 25-year mortgage setup, and the trust invests in capital growth assets. The payment each year is about $33,500, principal and interest, and you don't go finding new cash to make that payment. It gets paid as a franked dividend out of the bucket company, because remember, there's already a franking credit sitting in there. So in year one, that's a $33,500 dividend, and if it's structured across a couple of people, say $16,750 to you, $16,750 to your spouse, you each get a franking credit, and the top-up tax is small. And the whole time, that $350,000 invested in the trust is growing. Beautiful. The company holds a 25-year debt investment, earning a good rate of interest, and the trust, which gets the long-term capital growth discounts, holds the assets and pays the company deductible interest each year. Deductible because the trust's money is sitting in a growing investment rather than a private asset. Then 10 years down the track, let's say the investment's worth $700,000, it's doubled in value, and you decide to sell it. Because it's in the trust, the $350,000 gain gets the CGT discount. So you're taxed on, say, $175,000 under the current CGT rules. After 1 July, that stops being a flat 50% discount and becomes based on inflation instead. So instead of automatically halving the gain, the part you're not taxed on is worked out according to how much of the growth was just inflation over the time you held it. Either way, the trust still gets a discount for the growth of those assets. If that same asset had been sitting in a company instead, there's no CGT discount. So you're taxed on the full $350,000 at 30%. And then you've still got the dreaded top-up tax to pay to get the rest of the money into your hands. So across those years, the loan gets paid down using money that was already taxed in the company at 30%, while the original $350,000 stays in the trust doing its job. And when you finally sell, pick up the CGT discount that the trust gives you, and the company never would. By now, you might be thinking, this sounds complicated. And if it's that clever, there must be a catch or a risk somewhere. There's essentially no risk in this, and the reason is simple. It's your own money. The mortgage on your house isn't to the bank. It's to your own company. It's a piece of paper between you and an entity that you control. You're not going to foreclose on yourself, and the ATO is also happy with you. The one real risk is your accountant not doing the paperwork. The dividend has to actually get issued each year to make the repayment. And if that doesn't happen, that's where you can get into trouble. So it needs someone who's on top of it. But that's the responsibility of your tax accountant's guidance. The tax office made all of this look complicated, and I think that's deliberate, because if it looks hard, most people won't bother with it. But it isn't actually that hard, and it isn't that expensive either. You might pay $3,000 to $5,000 to set it up against $100,000 or more in tax saved. When you put it like that, it's not a hard decision, is it? Obviously, every one of our clients is different, and I work this out one person at a time, customizing advice client by client. It's what we do at Cotchy. For the right person in the right situation, this is the tool that lets you hold money where it does the most good and still keep the tax office happy. Now, this whole strategy only works because the money is sitting in a trust in the first place. And that's a bigger conversation on its own. A lot of people are being told right now that trusts are dead and buried, and they need to rush into companies, holding companies. I've put together a whole video on why I'm still using trusts for my clients despite all of that.